Hey everyone, Brian Bogner and Greg Towner here. It's time for the 5-minute market economic update here at Parallel Portfolios. So let's go ahead and get started. Take it away, Greg.
All right, great. Thanks, Brian. Well, our first chart is going to look, as usual, at the broad U.S. market, the S&P 500, and the story, as it has been for months now, remains the same. Nice, smooth uptrend. In fact, actually, we've consolidated over the last month and now surged in the last week, surged higher to a new high. So things continue to be quite healthy. You could certainly argue maybe we're a little extended above some of the moving averages in the very short term, but by and large, continues to be a healthy uptrend. One thing we wanted to tie in with that is we always talk about investor sentiment. So what are investors actually feeling? And this is a survey. There's a lot of different ways to look at sentiment. This is one survey that looks at it, comparing the number of bulls to bears. And if we look back at that spike there at the beginning of this year, you can see there was a lot of bullish people. If we flip back to the previous chart, the S&P chart, we can see that right there. That's the spike at the beginning of the year where the market went straight up and it seemed like it only could go up. You can see a lot of people got a little too excited there. But yet now we've traveled to actually new higher price in the market, yet the sentiment is still down at a low level, roughly equal bulls and bears. So there's just a lot of people not believing in this trend, a lot of people just not on board for whatever reason. So we think that's a good sign from a contrarian perspective that people aren't all bulled up yet on this market.
Yeah, I get a lot of calls from folks, and the conversation lately seems to be maybe we should be taking some money off the table, maybe we should be, pulling out of the market and things like that. So it's not a mindset, like you're right. Back here, I remember, hey, everybody wanted to pile in, and sure enough, we got a correction. So I've been hearing the same thing.
Yeah, in the beginning of the year, there's also the Bitcoin mania. And when you have something go crazy like that, it tends to bring a lot of other things with it, and it's general euphoria. And right now, you're not getting that. Right. Not yet. So another thing we wanted to look at, we talk a little bit about seasonals and market cycles. It's something it's a secondary factor that we look at. This is called the presidential cycle. So each one of those blue columns is one quarter in a 4-year presidential term, going all the way back to the late 1800s. If we look at the period we're about to enter, the next 3 quarters, it's actually the highest 3-quarter period in the 4-year presidential term. So, this isn't something that we're going to put a lot of weight in and completely bet on, but the fact that it aligns with our already positive views on the economy and the trend we just looked at and a neutral view on sentiment and other factors, just another factor that we think is a positive and something to keep in mind going forward.
Good. Now, Greg, talk to us a little bit about emerging markets. The reason being, I tell you, this has probably been the most frustrating area for me. If you look, here's a chart of emerging markets here. If you look at the uptrend here, it almost, of course, it did great in 2017, just like we showed in the S&P, had this big move up, and where the S&P consolidated and really moved to higher highs, that has not been the case here internationally. And so it's been a bit frustrating. Can you talk a little bit about that?
Yeah, exactly. And when we looked at the U.S. sentiment being kind of neutral-ish, we'd say the international, especially the emerging market sentiment, is quite negative. People just don't understand, why do we own this or what have you. And we don't need to, again, get into all those factors right now. But what we'll say is, we think, as we said last month, we might be in the stages of a bottoming process. It's moved a lot in the last month, but the result is it's basically at the same price point it was last month. Mm-hmm. But, yes, we are still kind of in an intermediate downtrend. But we think the sentiment has gotten so negative. We're starting to see some positive divergences technically, very cheap, above average growth. It doesn't mean the bottom is for sure in place, but it's at least an area you want to have some exposure.
Right.
Being is because of some of the potential there. Mm-hmm. If we look at the next chart, historically, when emerging markets have had 20% or greater declines, like we've seen this year, going back to 1990, the forward returns 6 and 12 months later are well above average. Now they're volatile. There's some big negative numbers there. There's some big positive. That's the risk reward with emerging markets. But it's hard to know exactly when those declines are going to end and they're going to have a sharp snapback. And sometimes it's hard to quickly get on board when they move so quickly. So that's why we want to keep at least some exposure and be aware that maybe we'd add more exposure if we start to see one of these significant recoveries.
Yeah. Okay. Good. So wrapping it up, U.S. stocks still in an uptrend. We still continue to be bullish. Sentiment not yet extreme. We're entering, the presidential cycle, which is favorable, and emerging markets, international in general, has been frustrating. Of course, a lot of that's been based on the dollar, but it's still been frustrating. It's volatile, but we could potentially be seeing a rebound here. So we're staying diversified. We're not, putting in one basket or the other here going forward. So if you have any questions, you know where to reach us. Here's our contact info. We thank you so much for tuning in, and have a great day.